What's up, future millionaires? Welcome back to another video. Today I'm going to be teaching you about some basic investing strategies, and these are things that you really are going to need to know if you want to be in the stock market. You want to stick around to the end of this video because I'm going to be going over so many different topics that are all very important to good investing. This video is the third episode in a series teaching you how to understand the stock market and make great investing decisions. Thanks for clicking on this video, and without further ado, let's make you a better investor. My first stock market strategy is to make sure to say no to FOMO. FOMO is the fear of missing out, and it's a very common thing among new investors. The reason you want to avoid it is that often when you have FOMO, you are already too late to these investments. If a stock is going up like crazy, most of the time, by the time you get there, it's already done most of its growing. You as an investor want to search for what's next, not what's now. One saying that I once heard about this that stuck in my heart is you don't want to be the guy that is buying today's news and selling tomorrow's losses. You want to be the guy buying today's rumors and selling tomorrow's news. What I mean by this is you want to search for what's in the future. One company that I really love is Meta. I think that Oculus is going to do really well over time. I'm not buying it because they're selling a ton of Oculuses. I'm buying it because I think they will. You want to look for what's tomorrow, not for what's today. So this might bring you to your next question. You see some great company that you think is at a great stock price. You wonder, do I buy it now? Do I wait a few weeks and hope it goes lower? That's trying to time the market. And usually timing the market is way too hard because honestly, you can't know what people's emotions are going to do to them. If people are thinking that a stock is going to go up, so they buy more, or they think the stock is going to go down, so they sell. So it's way too hard to time the market. What you want to do is called dollar cost averaging. This makes it so that when you get into a new stock, you are invested at a much more average price, so you didn't buy in at too high or at too low. Say that you did wait, right? And over the next few weeks, that stock went up in price another 10%, and then you're disappointed. You still buy, but you didn't get in at a good price. Now there is the other way, right? Say the stock kept going down and you actually did get a better price. Maybe it went down 10%. Dollar cost averaging makes this less of a hassle because you don't want to take that 50-50. What you do with dollar cost averaging is that you buy that stock over a period of time doing the same amount every, say, week or month, right? So an example would be like, say there was a company that you wanted to buy 5 shares of. So instead of buying 5 shares right now, what you instead did is that you bought 1 share for the next 5 weeks. This means that you will get in at the average price of the next 5 weeks and not have to worry about if it'll go higher or lower because you're going to get in at the price that is the average of the past 5 weeks. This leads me to my next investing strategy, which is to buy when the price is low and sell when the price is high. I know that may sound counterintuitive, but every new investor feels this way. You may think, the price of a stock is going up a ton, so I want to buy it. Oh man, my stocks are going down, I want to sell them. And that is you listening to your emotions, not to logic. Let me put it this way. Say Apple announced that this Christmas, all of their iPhones are going to be 50% off. Wouldn't that be great? So you need to look at stocks that way too. What I mean by that is if a stock is $100 and you believe in it, then you should still believe in it if the stock's $50. And honestly, maybe you should buy another so then your average price is $75, right? You want to buy into companies that you believe in regardless of the stock price because over time you think that stock will go up in price, not today or tomorrow. This type of investing that I'm talking about is called value investing, which I highly recommend. Value investing is looking for companies that are really doing okay, but there's an overreaction to the company, meaning the stock price has gone down. One example of this is Meta. Meta stock price has crashed about 50% in the past few months, yet I don't see much of a problem with the company. So I'm buying in, hoping to make a return as everything goes back to normal and more. Value investing is a more secure way to invest because it cares about math, not opinions. You're looking at the price of a stock, not your opinions on the stock when buying. If you go and search up your favorite stock on YouTube, dozens of videos will pop up telling you all about the stock, right? And why it's a great stock to invest in because of their innovation and all these things. But few will go into the math and go, is the stock price a right price to buy at? Because a company can be great, but if it's still overvalued, the stock price will still go back down, because if demand goes lower, then the stock price will go lower, regardless of how well they're doing, which is not a situation you want to get yourself into. And chasing all that innovation is usually that FOMO, right? So once again, you don't want to go after that. Our next topic is something we discussed in our first episode, but I'm going to be going over it again. This is compound interest. Compound interest is so important. One saying that I heard that I really like is it's better to have time in the market than to time the market, right? You want your money to grow at a compounding rate in the market, because over time, the amount that you grow at each year is just going to keep going up. And suddenly you putting in your money right now and earning $50 a year means several years down the line, you're making $100 a year, and so on. And that'll keep growing forever, which is great. You want compound interest. So you want to get in right now. I know you may not have much money and you feel like, I'm not getting a high paying job, I want to wait until then. But your money right now can turn into so much more if you just put it away. Did you know that if you put $1,000 into the stock market as an 18-year-old, when you are 65, on average, you would have $24,000. That is insane, and you want to get in right now. Well, that wraps up my video. These tips are so important. Thank you for sticking around to the end of this video. I suggest that you like and subscribe so you can get more content like this. If you feel like I missed something that I should have talked about in this video, please go leave a comment down below and I will reply to your comment and teach you what you do not understand. Have a good day.